think it's a really enduring message to people to stay disciplined, focus on the value of a dollar. Don't get too down when things are bad, and don't get too overhyped when things are good. And that's a really steadying sort of philosophy around here. When things are horrible in energy, things are actually not that bad for PrairieSky. And when things are going extraordinarily well for Western Canadian energy, we benefit from that, but we don't get over our skis.
Happy holidays. Welcome back to the Rose Bros podcast. This episode, we are joined by Cam Proctor, COO of PrairieSky Royalty, a multi-billion-dollar energy royalty company, for part 3 of our ongoing conversation. A lawyer by training, Cam completed his undergrad and law school degrees at the University of Victoria and University of Calgary, respectively. Prior to joining PrairieSky in 2014, Cam was the Executive Vice President and Chief Legal Officer of Sinopec Canada, as well as the Vice President, General Counsel, and Corporate Secretary of Daylight Energy. Before Daylight and Sinopec, Cam was a barrister and solicitor at Cassels Graydon LLP, specializing in corporate securities, mergers, and acquisition law. Aside from PrairieSky, Cam is an avid outdoorsman, enjoys spending time with his family, giving back to the community, and is just a great guy in general. We sat down for a smooth cup of Rose Bros coffee and discussed the recovering Canadian energy industry, effective capital allocation and why it matters, the realities of a transitioning power grid, Berkshire Hathaway, and a lot more. Enjoy! Also, this week's podcast is brought to you by A1 Web Development. Looking for a new website or e-commerce storefront? A1 can help launch your business online through Amazon, Shopify, Walmart, or eBay to access millions of new customers. Check out a1dev.ca today for more details on how you can grow your business. Yeah, we're recording now, so morning.
Good morning. Good to see you. I'm glad we are doing this for the third time, and third time's the charm because it's the first time we've done it in person. So it's good to see you.
It's awesome. I really appreciate it.
You bet.
You're probably one of the most well-spoken people I've had on the podcast. How'd you get there? How'd you learn that?
That's not a compliment I get very often, but thanks for that. I don't know. I suppose I talk to people all day long in my job, whether it's staff, investors, any one of our 350 different counterparties that we do business with. So when you're in that type of role and you're managing lots of people and you're managing lots of business relationships, communication becomes a very essential part of it. Thanks again for the compliment. That's not something I get very often, but I appreciate that.
Also, you are the only one who's read Berkshire Hathaway reports. This will be episode number 75, and no one reads those things. So.
I love those guys,
well,
and I love the fact that you love them too. They're exceptionally smart, and what's really interesting to me about that group is discipline, the capital allocation. They are getting older, as everyone knows when they see Warren and Charlie, but they still maintain that sort of crisp discipline and simplicity in how they look at things, which business people can tend to overcomplicate simple concepts. However, they seem to be able to distill things down to a pretty succinct sort of thesis, and that's what resonates with me, perhaps because when you boil it down, I'm actually a pretty simple person. So
yeah, I'm not that smart, so they make it easy.
That's probably a better way of saying it. Yeah.
Clear thinking.
Yeah.
So how are things going? PrairieSky just closed a big deal. Heritage Royalties, $720 million.
Yeah, it's been 2021 has been, I caution saying this word, but it's been pretty transformative for our business, actually. 2020 obviously was very challenging. I think one of the first times we talked was right at the beginning of the pandemic. Yeah. And then we talked kind of in the fall after oil had sort of bounced off the bottom. And so in 2020, we were looking for deals. We were trying to find transactions to do. Most of our time here was spent kind of working with counterparties and helping them work through sort of business issues that they were experienced due to low commodity prices. But then it did sort of rebound off the bottom, not as quickly as I think some would have thought, but definitely bounced back relatively quickly. So when the window for doing acquisitions and adding complementary assets to our already fairly unique business arose, and we jumped on it. So 2021 started off with a bang. We acquired a really nice asset package, very complementary to our business, from Paramount, who's a great counterparty to deal with, for $45 million. And then throughout the year, we expanded our assets in the Clearwater play, and we'll come back to that at some point in time because I do want to talk about the Clearwater. So we did a big acquisition with Spur, an existing counterparty of ours, in the summer for $155 million, and then bought a title package and royalty package off Carve for around $33 million. And then as you alluded to, at the end of November, we announced a big transaction with Heritage Royalty for $728 million, which adds roughly 2 million acres to our asset portfolio. So it's an important transaction for us in a number of ways. And just humor me for a second and I'll walk you through some history, give you a bit of a history lesson. But mineral titles were really created back in the 1800s when CP Rail and CN Rail built the railroad to open up Confederation to Western Canada. And those are granted by the federal government to private enterprises. For a long period of time, those titles were held under the railroads, and then over time they sort of were split up. Most of PrairieSky's assets come from those railroad titles, and there's very few other major owners of them. But when Encana and Cenovus split, they split up the mineral titles. PrairieSky acquired all the Encana titles, and then Ontario Teachers Pension Plan acquired a bunch of titles from Cenovus in 2015 through a transaction purchasing Heritage. I mean, Heritage Royalty is kind of a partnership, but it's 100% owned by Ontario Teachers Pension Plan. So we white mapped them out of Canada with the exception of a few different assets. That was a very, very, very complementary asset transaction for us, and one that really reunified some of these old CP Rail titles that date back to the 1800s. So it does a lot of cash flow. It's in the oily part of the basin, very unleased. So gives us a bunch of future growth potential, but it also comes with other minerals such as helium. It's got a producing potash mine. It's going to double in size over the next number of years. There's lithium potential. There's carbon capture potential. And it's an asset that's more like our business than anything else we've seen in the last 8 years since we started the company. So very pleased we were able to do that. Ontario Teachers is a great counterparty to deal with. We were able to slam it before the end of the year. So,
lithium, carbon capture, those are a couple hot topics these days.
They are.
Lithium would be very, very interesting.
Yeah. So what's unique about PrairieSky's portfolio is we're the largest mineral title owner in Western Canada, private mineral title owner. So we have around 18 million acres of land. But with that bundle comes ownership of petroleum, natural gas, every mine and mineral that's part of that mineral package title, which includes potash, lithium, helium. There's actually been, most of the lithium production in the world comes from evaporation sources. So water's pumped from below the surface into these massive evaporation pits, and then effectively it's scraped off and refined, and that's what's used in batteries. But in Western Canada, there are actually high concentration of lithium brines below the surface, and those can be either in existing pools, or typically you find high concentrations of lithium in old conventional oil pools that are producing a lot of water. So these old Leduc reefs and things like that. But the technology is advanced in Western Canada, and there's pilot projects to do this hyper evaporation technology. So water's pumped to the surface, it's evaporated, the lithium is extracted, and then the recycled water is then redistributed and pumped down hole. So it's a very ESG or environmentally friendly process where you don't have all the water effectively leaking into the atmosphere. It's just being recycled down hole after you extracted the mineral. So we think that provides some upside potential that doesn't exist in the stock price today.
Between the Encana lands and the Heritage Royalty lands, you guys have the whole checkerboard.
We do. Yeah, and it's
because that's what it was, right? A checkerboard.
It was checkerboard. Yeah. So the way the grants were made in the 1800s was every second section of land So that's where the checkerboard comes from, with a 25-mile radius on any sort of spur of the railroad. So on either side of any railroad spur, every second section within a 25-mile radius. Now, there are some big consolidated blocks that we have. We have a big block down in Lethbridge, which was a grant that dates back to when the irrigation canals were built down there. And then there's also a big contiguous block that's east of Calgary that stretches kind of well past Brooks, that relates to the same type of thing when the irrigation canals were built east of Calgary to support the agriculture industry. So it's
that's good for you.
It's an amazing map. Like, we were looking at, Andrew, my business partner and I were looking at a map the other day of our IPO lands. So when we formed the company in 2014, 5 million acres, and today at 18 million acres across all of Western Canada. It's a pretty impressive land map. I think from a land position perspective, it's second only to Canadian Natural Resources, which obviously one of Canada's leading hydrocarbon producers. But from a mineral title perspective, it's absolutely unmatched. So
monopoly.
I don't like to use the word monopoly, but
every monopoly doesn't like to be called a monopoly.
Yeah, it's. I guess the better way of explaining it is, as a PrairieSky shareholder, you don't have to pick the management team. You don't have to pick the play, because if you buy a PrairieSky share, you have exposure to all of them, ranging from, the best parts of the Montney in Northeast BC all the way through Clearwater into Saskatchewan, all the great oil places there, and then also all the way into Manitoba as well, into Western Manitoba. So it's a very expansive land base.
That's awesome.
Yeah.
This time last year compared to now, I read, I think PrairieSky's revenue earnings were up 100%, 200%. Tourmaline was like 9,000%.
Yeah.
That's rare.
It is. Yeah. And now obviously last year when in 2020, we had negative oil pricing. What's helped quite a bit is you've seen oil prices move up into the 80s. Now they're sitting more around $70 a barrel today as we talk. Gas prices, we've seen the best natural gas price in Western Canada in years, although that's tapered off a little bit still. But one thing that's different between PrairieSky and producers that sometimes is missed in the conversation is margins and margin compression. So a royalty barrel that we collect is 98% operating margins. So we get a barrel that's free of cost. It doesn't have any capital costs in it. It doesn't have any operating costs in it. It doesn't have any abandonment liabilities associated with it. So it's basically your net back is 98%. It's your realized price without any cost that goes into it. So as you get into an inflationary environment, which I think we're in right now in the Western Canadian Sedimentary Basin.
Good to own land in inflationary environments.
Exactly. Your costs of drilling, completing wells, your cost of operating wells, your cost of labor, all of those different types of things can force margin compression on a producer. But because a royalty barrel is free of all those costs, it's effectively a no deductions barrel of oil or GJ of gas, you don't get the same margin compression. So while you see big revenue swings on producers based on price, you're also seeing cost creep and cost inflation come up, whereas in PrairieSky, you don't get that. What you really get is unhedged leverage to the commodity without cost inflation.
Plus a yield on the dividend.
Yeah, so our dividend yield, and this is I know you love to talk about capital allocation.
We'll get into that. We will.
Yeah, we will. But it's interesting because in the last year, the energy business went from, or let's say the last 18 months, the energy industry went from cutting dividends completely to increasing dividends almost irrationally, in my mind. And so during 2020, we did cut our dividend, and we cut our dividend kind of in line with what cash flows were doing when commodity prices dropped, but it never went to zero, and it never would, it never should. But we cut it down to a level where we thought, okay, we can support this dividend through any commodity price shock, but also giving us the ability to generate free cash flow to buy things at points in the cycle where they look attractive. And one thing that we like about our business and our capital allocation strategy is we do generate a lot of free cash flow, but we give it back to shareholders in a number of different ways. One's the dividend. So today the dividend payout ratio would be 25% or less. Then we also buy back stock. And I know we talked about this, I think in the fall of 2020, when we chatted last, we bought back roughly 5% of our stock and paid that off in just a number of months with our free cash flow. All the acquisitions we've done through 2021, we paid for using free cash flow generation. And part of the reason we could do that is because we have a low dividend payout ratio.
Strategic.
Yeah. Other producers are saying, okay, well, or other oil companies or energy companies are saying, okay, we're going to give more back to shareholders. And so they've increased their dividend, 3-4 times throughout the course of the year. We've increased our dividend twice this year, but we've always kept it within a level where it gives us a lot of flexibility to do things that improve the business for the long term, right? Because once a dividend is paid, it's paid. Whereas if you're retaining some earnings, retaining some free cash flow to do complementary acquisitions or keep cash on your balance sheet, because in energy, there's one certainty in the energy business, and that is there's going to be ups and downs. And there's always sharp things around the corner. So maintaining a conservative balance sheet, maintaining a conservative payout ratio is important for us just from a sustainability perspective. But on the Heritage deal, we wouldn't be able to do that deal the way we did it without a low payout ratio, without having a big free cash flow generation, but giving less of it back to shareholders or paying out less of it in dividends at this point in time. Now it's $728 million. We issued some equity to buy that asset, but we also used debt leverage to pay for the balance of it. So it was equitized about 1/3 and debt for 2/3. But because of the low payout ratio and the free cash flow generation in the business, we can pay all that debt back
pretty
by
quick.
2023.
Yeah.
Right? And so as a shareholder, you have this wonderful asset. Very few shares were issued to buy it, and it'll produce for the next 30, 40 years. So you get the benefit of all of that without over-equitizing it and diluting shareholders. So that's how the benefit, in my mind at least, of keeping a lower payout ratio and a conservative balance sheet gives you flexibility to do smart things at the right point in time. And we think we've done that.
Do you think there's a perception in the average retail investor of expecting a dividend from an energy company and kind of that reassurance, whether rightfully or wrongfully?
Well, I think you're absolutely right. There is a perception of that from retail investors, but PrairieSky is about 93% institutionally held. So big shareholders would, include the largest portfolio managers in the world. Fidelity, Royal Bank Investment Management is a large shareholder. EdgePoint out of Toronto is a large shareholder. We actually have some large European investors that have come in over the last 18 months. And so the retail component of PrairieSky is smaller. Certainly retail investors like that higher yield, and there's places they can find it in energy if they want. But most of our institutional shareholders are of the view that, management is paid to do things that create value
Makes
over
sense.
the long term. And I've had one portfolio manager, one of our top 5 shareholders, say to me, if you give me more dividend, I then have to find things to do with that money. And that could include buying more PrairieSky. It could mean buying other things in my portfolio. But his comment was, can you not find things to do with that money
Better.
that make the value of my shares go up over the long term? And I think with all the acquisitions we've done in 2021, being over $1 billion of M&A, adding over 3 million acres to the land position, we believe that does make the business better and makes every share more valuable.
That's nice to have people in the room you can talk to intelligently about that.
Yeah, we're really lucky that way. We have a great shareholder base. A lot of the relationships have been cultivated over a long period of time. There's a high level of trust and transparency. But I think that's ultimately what management gets paid for, right? You don't get paid to just come in and put your feet up on your desk. You're paid to try and create value over the long term. If there's a point in time where shareholders don't feel that that's happening, then changes should be required. And I think that's true not only in energy, but across all businesses.
Do you think that current equity stock prices are reflecting the value of energy as a whole and or PrairieSky?
I don't think they are. And I think there's a few different reasons for that. I think the investment community, the broader investment community, has started truncating long-term value assets in energy, saying at some point in time, oil or natural gas or whatever else is going to become obsolete. And so the multiples have contracted because investors are truncating the value of a hydrocarbon barrel. Now, I think there's been some reversion back to the mean on that sort of thinking. And then this week, there was a thesis out from Canada Pension Plan, which is I don't even want to say the number, but I think it's around a $400 billion, maybe $500 billion
It's a lot of money.
fund. It's a lot of money to invest, but while they had been a large divester of hydrocarbon stocks in their equity portfolio, but are also a large divester of assets as well, they've kind of come back to the middle and said, we're not going to divest hydrocarbons. We're going to try and work with high emission industries to reduce their carbon footprints over time. And I think what that recognizes that energy is important. Energy is a big part of how the world goes around. Energy businesses typically are large investors in R&D and finding ways to do things better and more efficiently. They're going to be leaders in any sort of energy transition that happens. And so I think there has been a little bit more of a reversion back to more tempered thinking on energy
Rational.
and values of energy, given that people understand it's going to make up a large part of the complex going forward. We just have to find a way to make it more carbon neutral.
I saw a clip, I talked about this, I can't remember who with, maybe Mike Blinky, but it was Elon Musk saying, here's the guy leading everything, the change in electric vehicles and all that. And the clip was him saying he wouldn't flip the switch on traditional energy even if he could, because it would be catastrophic. And he's the guy centerfold of all this. And he's saying that.
Well, he is. And I think I think when Elon Musk is an extremely smart guy and he's been very successful, and he's one of those rare visionaries in our life that has, and it's not just the Tesla piece, it's a whole bunch of other different things. He was early on in sort of electronic payments, very, very smart guy. And I've read, a number of the books on him or by him. But I think when you think about electric vehicles, you have to think about the grid and you have to think about where the electricity comes from. And in Alberta, while it's transitioning, a lot of the electricity still comes from coal.
Yeah.
We're not blessed with the hydroelectric capacity of, Western Canada and Eastern Canada. But then if you step outside your box a little bit and you look around the world, and I know you've done lots of traveling, whether it's, personal or ski racing, I've done lots of traveling around the world, every continent. And, the reality is we're blessed with access to energy, relatively cheap energy, but that's not the case all over the world. And so while we can be leaders in energy transition in North America, that technology has to be developed here. It has to be broadly disseminated around the world, and that will take time. And so you can't, to Elon Musk's comment, you can't flip the switch on conventional energy because the ramifications for that globally, not just in yours and my day-to-day sort of existence, but globally, particularly for more at-risk populations, could be catastrophic.
Yeah.
So
even here, it's minus 20 out today. It's freezing.
Yeah.
What would we do?
Yeah, I don't know. I mean, we can't all afford Canada Goose jackets, so you do need energy, and you do need energy for a lot of things. But there is a slight frustration when you talk about electric vehicles and other things, converting other things to electricity, because it does require pulling on the grid, and renewable capacity only has so much breadth. Right, you do need base load to ensure stability, to make sure that we can continue to work and heat our homes and grow vegetables and do a whole number of things. So it's a more complicated issue than I think sometimes people understand.
Exactly. Good thing is you guys have lithium mineral rights.
We do, yeah. We have lithium. seems like we have infinite natural gas too, which is a good bridge fuel. But more importantly, I think in our portfolio, we have some of the lowest scope emissions oil production as well. So when you think about not every oil barrel is the same. Some of them come from high cost plays with bad environmental records. They use a lot of fresh water to produce them. Whereas the barrels that we typically produce on our lands come from extremely efficient plays, low water use or nil water use because the water is recycled, low surface impact, and overall very low carbon. In fact, a lot of them come from enhanced oil recovery where carbon dioxide is permanently sequestered below the surface to produce those oil barrels. So, not every barrel is the same from that perspective, but I think in our business we feel that part of the strategic advantage is those barrels do come from the lowest cost, most efficient, most ESG friendly regulatory environment in the world. And so to the extent oil does taper off both demand and supply, the last barrels produced in the world should come from this jurisdiction.
Yeah.
So
for sure. Well, why don't we get into a mutual passion of ours? Capital allocation.
Okay.
Elon Musk might call us boring. I don't know why. It's just something I find interesting.
It is. It's actually, from an executive perspective, it's one of the most important jobs.
Yeah. How
you allocate capital, because what you're really doing is you're acting as a custodian for other people's money. So all the way down the wealth management sort of scale, you have individuals or employers who are deciding to put their money into different funds to be managed by other people. And those managers themselves make decisions on what stocks to buy, how to balance their portfolios, whether it's, what the risk matrix is and how to allocate capital on that basis. And then beyond that, the executives at the companies that those mutual fund investors or individual investors invest in themselves have to make decisions on how to best allocate capital according to a strategy. So it's a super important part of any business, whether it's energy or something else.
So the outsiders, William Thorndike Jr., basically there's 5 essential choices for deploying capital: investing in existing operations, acquiring other businesses, issuing dividends, paying down debt, or repurchasing stock.
Pretty simple when you boil it down to those 5 things.
3 alternatives to raising it: tapping internal cash flow, issuing debt, or raising equity. So these are the options collectively in your toolkit.
Yeah.
How many other energy CEOs or managers in general do you find that you meet that think along those lines?
There's quite a few. I think I'll say this, 8 years ago when we started this company, there were very few, right?
Really?
There was a very much a focus on growth at all costs, without really giving a lot of thought to, how that growth is funded, whether that growth is the right thing for the business at that point in time, and also price elasticity. But today, capital allocation has become a bigger focus in energy. And one of the big reasons why that is access to capital has become more difficult for energy. And whether that's because there's less money available to the energy industry through debt or equity, or multiples have contracted to the point where you as a manager of a business don't think it's worth issuing equity as part of the capital raising. But it's forced energy businesses into being more disciplined and looking more at, how do I manage this business for the long term? How do I become more resilient in the face of a more volatile environment, which of course we've seen a lot of over the last 6 years. But those 5 points and then the 3 points on sort of where the capital comes from are instrumental. And I can give you my thoughts. I always think first, and we always look at everything on a leverage neutral basis. So we assume that we have to issue equity to buy things. And that includes if potentially an acquisition or investing in the business. But the value of a share is something that I find sometimes gets taken a little bit too lightly.
Absolutely.
Companies are too some companies are too willing and too open to just issuing equity at any moment in time, irrespective of whether it's good for the value of the existing shares or the new shares that are being issued over the long term.
Yes.
And so we always look at a value of a share as almost a sacred thing. And part of the reason for that is that we're all large shareholders of our business. And so there's a good alignment with existing shareholders. So dilution is a big X on the board. We don't like to issue equity. Sometimes we have to in order to sort of take advantage of strategic opportunities. But my preference is always to look at internally generated cash flows as ways to fund both internal efficiencies in the business or strategic opportunities that could be additive. But I think like I said at the beginning, I think it's changing somewhat in this industry, people focusing more on the value of a share as opposed to just the value of growing. I'm not saying that's true across all companies, but I think it's become more common thought.
One would argue the real value is in the quote unquote R&D intellectual property through the geologist. Have you seen that kind of reduce in a mature basin in Canada and the value shifting towards, like you say, capital allocation?
I think it has, and it may potentially create issues long term. Western Canada has always been good at finding the next best thing and finding new technologies to make things more efficient. But there has been a very significant and steep decline in exploration activity.
Exactly. Yes.
And so as oil wells decline or as pools are depleted, there's less supply because there has been less rejuvenation in the industry. Now I think that's changing a little bit. Now we don't put risk capital ourselves directly into the ground. Like we don't drill wells, we don't do exploration ourselves, but we do have access to all of that because of our expansive land position.
You have to know what you're buying.
Yeah, you have to know what you're buying, and you have to know where you see future value. So when we buy things, we start by looking at the asset and we work it up from a geological perspective.
Exactly.
So we look at the rocks.
Exactly. We
look at all the delineation of the well bores. We look at other technologies that are working across the basin and think, can this be applied here in a new way to find new hydrocarbons or extract them more efficiently? And so you always have to look at the asset that way. Yeah. Now, if you talk to, there's a lot of geologists in Calgary. There's fewer today than I think there was 10 years ago. But there's lots of hydrocarbon accumulations that exist in Western Canada that could be extracted using future technologies. We just don't really know what those are going to look like. But that's part of the reason why owning royalties and owning fee title land that has a perpetual life to them benefits you, is because you get all the benefits of those without any of the incremental costs. So, as some new geologist comes along and finds a new hydrocarbon deposit or a new way of getting it out, such as the Clearwater, where we're the biggest landowner in Western Canada, that benefits us without any incremental cost. So
I guess the real valuable companies are the ones that can combine the intellectual property with good capital management and a sharp thinking in that end.
That's right. Yeah.
Like Tourmaline or you guys.
Yeah, Tourmaline's an exceptional example of that.
Yeah.
They've been very, very good at becoming a low-cost, efficient driller, investing in infrastructure along the way to keep those costs low, investing in water handling and recycling. So, and it's good to see a business like that become so successful in Western Canada because it just draws more attention to the basin.
Yeah.
So,
do any names come to mind in terms of good capital allocators in Canadian energy or in general?
Well, I think the best one,
other than Warren Buffett.
Yeah, they're Warren Buffett. Yeah, the best one in energy has to be Canadian Natural Resources.
Murray Edwards.
Murray Edwards, yeah, without question. I think they're very strategic in how they buy things. They always maintain flexibility to be opportunistic at the right points in time in the cycle. But they're also, they have a very, very long-term view and invest capital knowing that their assets can produce in a very efficient and stable manner for a long period of time. So in my books, they're the best capital allocator in Western Canada, without question.
How hard is it to effectively manage capital in the energy industry?
It is difficult. It's different for a royalty company versus a producer. And part of it is just the risk. The risk profile is different because when you're allocating capital from a producer standpoint, you're managing field operations, you're managing health and safety, drilling and completions, you're sourcing water, you're sourcing a whole bunch of different services. And any one of those things can go wrong at any one point in time. And so it's a bit more of a complicated matrix than when you're running a royalty business. So there's a lot more inputs that go into it. So from that perspective, it's more difficult. When you're looking at a royalty business or working in a royalty business, you're really trying to find. It's difficult in our company because we love our existing assets. So every incremental asset we look at has to be measured against, is this better for existing shareholders near, medium, and long term? Does it create more value per share? Or would buying back stock create more value because the value of the existing asset is below intrinsic value, so you can buy back cheaper? Or should we be giving back more returns through dividends?
Yep.
And sometimes that just says, well, that's what shareholders want, or it says it's the most efficient use of capital because buying back stock doesn't make sense at this stage, or there's nothing else to buy that makes the business better. So you might as well give it back. Now, we have more debt on the balance sheet today than we ever have had in the company's history, partly because we just closed our acquisition of Heritage. Right. But that will come down materially, and every other acquisition we did in 2021 was done using, short-term debt on our credit facility and paid back.
Yeah.
Right. So the existing shares are better off because they include ownership of those assets, which have been paid for in a very short period of time.
Yeah.
So the thesis on that type of capital allocation for us remains intact today. Use short-term debt, pay it down using excess free cash flow, and existing shareholders own that asset forever.
What would be your benchmark for cost of capital? Would you say it's treasury bond, or would you use the Standard & Poor's index fund? How do you compare yourself? Yeah,
we look at a whole bunch of different things. Part of what we look at is where we think our intrinsic value is based on the long term. Now, that's a hard thing to measure, and you also look at dividend yields and other things. But I tend to be more biased because I do love the long-term attributes of owning a hard asset that never expires. So I tend to think at most points in time, the intrinsic value is higher than where the existing equity value is trading. So we look at it from a number of different ways. It's not just a simple kind of look at bond yields or look at the S&P or anything like that. It's a bit more of an asset value up perspective.
One thing I noticed is some people in energy say their returns are good compared to the sector, but then when you compare them to, like I said, a pretty simple index fund, it doesn't look so good anymore. How does that conversation unfold with institutional investors? Well,
I think they have to look at
long-term.
The long-term, they have to look at capital structure of the business. They have to look at, business through all different points in the cycle, depending on what type of investor they are. If they're a long-term investor, that's the way to look at it. If you're a short-term investor, you're looking for catalysts and you're looking out for opportunities to trade. But, I look at PrairieSky. In 2020, we did, I think, $150 million of free cash flow in a year where basically the world and the energy business was knocked on its knees. I think the upstream energy business in Calgary or in Canada more broadly did, I think, -$9 billion.
Yeah, it's abysmal.
Yeah, so that's where I go back to like margins and sort of performance through all cycles, and resiliency through all cycles, which is something that you can't just throw into a spreadsheet. But in a year where we did $150 million of free cash flow, where basically everyone thought energy was done completely, the industry itself did -$9 billion. Whereas this year, I won't give guidance, but I think most analysts for 2020 have us pegged somewhere in the kind of $320 to $340 million range of free cash flow.
Yeah.
So, and it's still a 98% operating margin business. because you don't have that compression.
Right.
So
with rising interest rates, that's not good for tech companies, but it may be good for PrairieSky.
well, yeah, and that's partly why we're bringing the debt down extremely fast. It's probably not great for tech. It's probably not great for.
Although I wouldn't bet against Microsoft.
I wouldn't. Yeah, I know. I like tech, and I like those. They become more mature and enduring businesses. Probably not good for real estate, because typically a bunch of those real estate businesses, carry a lot of leverage. So that could impact returns.
How common is it to meet similar-minded people like yourself who read Berkshire and understand that perspective? You find you meet many people like that? I don't.
I don't. Fortunately, I sit down the hall from two people who share that exact same philosophy. And I think a lot of our largest shareholders share that philosophy as well. But I like learning those things. I like watching the best. And I like this. I like the narrative that comes out of Berkshire. I mean, here you've got some very, very successful people, but also very humble people. And I'm sure you've watched the biography of Warren Buffett about, his daily habits, drives a Buick, lives in the same house he's lived in for 40 or 50 years, goes to McDonald's and, gets a change out of his change drawer to pay for his breakfast. I just like that kind of stuff. I think it's a really enduring message to people to stay disciplined, focus on the value of a dollar, and don't get too down when things are bad, and don't get too overhyped when things are good. And that's a really steadying sort of philosophy around here. When things are horrible in energy, things are actually not that bad for PrairieSky. And when things are going extraordinarily well for Western Canadian energy, we benefit from that, but we don't get over our skis. So, and that's the way we deal with investment decisions here. That's the way we deal with our staff. Through the pandemic, we didn't lay anyone off.
Yeah, that's very uncommon.
It is really uncommon, and we bonused all of our staff in 2020.
Yeah.
So whereas the executives didn't really make money because a lot of our compensation is tied to stock, which is fair. That's fair. It's part of the. We don't look at things in a 1 year sort of window. We look at things over 1, 3, 5, and 10 years. But with our employees, while we rely heavily on technology to run our business, we have a very dedicated and specialized group of people here. And so we treat them very, very well through all cycles. And that's something I'm actually extremely proud of for our company.
It's so easy, and it seems common that the executives just take it out on the employees and they get paid millions regardless. And it's just the way it is.
It is, yeah. And there's a lot of knee jerking in energy where things get a little bit, you hit a little bit of turbulence, and all of a sudden the first place you go to manage your business is cost cutting.
Yeah.
Right?
Employees.
And it's not always the way to go about things. You have to think about, okay, how do I position myself in these tough times?
Yeah.
How do I make investments in the business during these difficult times that will benefit me over the next year or over the next 3 years? And most of the answers to those questions start with talking about people and the value of people and the value of people's contributions and how you can motivate them. And
I don't think CNRL has laid many people off, if any, have they?
No, they haven't. They would look at things, I think, in a very similar way.
Yes, exactly.
And the other thing about CNRL that's similar with PrairieSky is that they run lean.
Yeah.
And so while they never get overinflated during really inflationary times in the basin, which gives them resiliency to maintain staff headcount and maintain their G&A through times when there are challenges in the basin. Whereas there's other companies and lots of other companies that just, when things get busy, they hire like crazy, and then at the end of the day, when things slow down, they trim. So, and we've been subject to that a little bit, because in this busier environment in late 2021, we've had some people trying to poach staff from here. And at the end of the day, the message I always give to our staff is, well, you've seen how we deal with employees over an 8-year period, including some pretty tough times in energy. This business offers you stability, good compensation, good work. You're part of a team, part of an organization when you can come upstairs and walk into the CEO's office and have a chat with them at any point in time. That's a little bit unique.
Yes.
I would say.
Another thing that I like about Berkshire, it's just the values. Even though they're the best in what they do, it's almost the underlying values. Elon Musk may criticize them because they're not, reinventing the wheel, but that's one of the things that attracts me. It's just the values.
And I think I 100% agree with you. And I think values can drive performance in organizations. And I think it's values and leadership gives an example to people. It makes them feel comfortable. They know what to expect.
Yeah.
Whereas some other businesses, high pressure and sort of high turnover rates, I think tend to leads to high burnout.
Yeah, not as good performance.
Not as good performance over time. So
Yeah.
at least that's our philosophy. Now, if you talk to some of my employees, they'd probably say that we're pretty demanding around here. We are. But one thing I could guarantee, and I think this is the exact same with Berkshire, is the managers and the senior people in the organization work just as hard, if not harder, than the staff. And so from that perspective, it's a unit, it's a team, and it all works together. I mean, Andrew, who's been my business partner for 8 years, he's one of the first people into the office, if not the first one. He unloads the dishwasher, and he's one of the last people in the office at the end of the day, and he loads the dishwasher and turns it on. That's pretty unique for a CEO, and he's, that's a philosophy that's permeated the organization. And I think with Berkshire, coming back to the values comment, that's the same type of thing. They work hard, disciplined, they're good communicators, and they lead by example.
There's like 12 people in the Omaha office.
Yeah, most of whom have been there their entire careers or are long duration.
Yeah.
They probably like going into that office and being part of it.
Yeah.
Right.
How many athletes are you supporting in the sport of ski racing nowadays?
Yes, we're supporting we support Alberta Alpine.
Okay.
So indirectly, we're supporting kind of that organization. And
on a side note, you guys are big skiers. For anyone that does listen to this, Andrew's a big skier.
Yeah.
You're a big skier. And you're giving back to the community in that sense.
We do, yeah. It was actually one of our first community investments we did when we started the company, working with Alpine Canada. Started out with a few athletes there, and we've talked about this in the past. But it's sort of evolved over time. So Andrew's president of Calgary Alpine Racing Club. My wife Kim is actually president of Panorama Ski Club. And so we used to have 2 kids in Panorama. Now we just have one. One's moved on to hockey full time. But yeah, this year we're supporting Alberta Alpine in a bunch of different ways. Alpine Canada, we're supporting in a few different ways. And we have 4 athletes that wear PrairieSky branding this year. So Trevor Philp, who's a technical skier, but actually skis Super G, just came in top 20 in the Super G in Beaver Creek in one of his first Super G races. So excellent guy from Calgary. And you'll find a theme here about proximity to Alberta in the names. But Brady Lehman, I know people are probably familiar with Brady. Great guy, just an excellent human being, and gold medalist from the last Olympics. Coming up on the next Olympics, we're hopeful he'll be going to that. I expect he will finish second in his first race this year in the test event in Secret Garden. So really excited to see what he can do. I had lunch with him actually kind of before he was headed over to Europe. He looked like he was in the best shape of his life. Just an absolute mutant, like just incredible. Yeah. He worked extremely hard coming off an injury last year. So we have Trev and Brady under the brand, and then 2 new-ish World Cup skiers. So Britt Richardson, it's our first year sponsoring her. She's from the Calgary Alpine Club as well. And then Cassidy Gray, who we know pretty well from Pano, and I know you know her as well. So pretty excited to have 4 athletes. Pretty excited to have gender parity in the athletes we're sponsoring. But got some veterans in there with Trevor and Brady, and really excited to see what Cassidy and Britt can do on the World Cup and in the NORAMs this year. I mean, the thing I would say is they're they're all local. They're all exceptional people. They'll all find ways to kind of give back to the sport that's given them the platform that they have today, and really excited that we were able to partner with them.
But you work too much. You can't ski yourself.
Yeah, I'm not skiing a lot this year because I'm back to coaching hockey. So I'm gonna head up to Pano over the holidays, get a little bit of a break, and then I'll be back to Calgary on the 1st to keep coaching hockey. So it'll be Christmas break, maybe a little bit over spring break, and then some end of the season sort of spring skiing with the occasional patio stop for a beer.
That's the best skiing.
It is, yeah. It's the best.
That's what I always say. It's like Christmas and spring. But I don't really need February and January.
Yeah. But it was funny. One of my friends from Pano was giving me the gears a little bit, saying, you're not going to be up at the ski hill, and
like, fine.
It's too bad. And it's like, it's interesting. Like while we have a lot of great friends up there and really enjoy being up in the mountain, like the mountain lifestyle, the opportunity to spend that much time with my 13-year-old son and coach him in probably what will be the last opportunity I have. I'm pretty sure in 10 years when I look back on it, I won't be, thinking about the opening day weekend at Pano I missed in 2021 when there was 50 centimeters of fresh snow. I'll probably be thinking about, the time I got to spend with my son and his friends, and being around the rink and being in the room and doing all those fun things. So it doesn't last forever.
What are you reading these days?
This is going to be a boring answer because not a lot.
Work too much.
Yeah, since this year has been an extraordinarily busy year, so I haven't read very much. I got a few things that I've given to Kim to get for me for Christmas, so I'll have a few of those things to read. But I'm probably going to read a little bit of junk food for the brain. Yeah. Probably won't read the business books over the holidays.
What's junk food to you?
Well, I got James Duthie, who's like a commentator on TSN. I got his book called Beauties.
I saw that one.
Yeah. I think it's just a collection of stories from around the hockey community. Yep. And then I got Brian Burke's sort of book about it's along the same lines about his career, but like stories from around the league and stuff. So not that I should call that stuff junk food, but it'll just be pure entertainment and probably a few laughs. So looking forward to curling up, on my couch, get a cup of Rose Bros coffee in me and read a few books over the holidays when I'm not skiing.
When you're not skiing.
Yeah.
As long as it's not -20 like today.
Yeah, it's a little bit warmer out in Invermere, so I'm hoping it stays that way.
Well, that was a great conversation.
Yeah, thanks for having me. Glad to be back for the third time. We got to get your brother. On the pod so we can have a little 3-way conversation one of these days.
Or Andrew Phillips. We'll do ski racing energy. If you're listening, Andrew.
All right. I'll work on Andrew. We'll try and get him on here at some point. Yeah, thanks for having me.
Hey, thanks for listening, everyone. Hopefully you enjoyed the episode. If you like what you heard, check out rosebros.ca where we will have upcoming shows. Until next time, happy coffee drinking.